At this time, I would like to ask Joey Samowitz, Director of Policy Development at the Conference of State Bank Supervisors, Tom Seams, Chief Economist at the Conference of State Bank Supervisors, and Kathleen Navin, Senior Business Economist here at the St. Louis Fed, to join us at the front of the room. They're going to present the findings from the 2024 Annual Survey of Community Banks. The survey has been a feature of this conference since its second year in 2014, and it provides information and insights that we believe are not available elsewhere. That is one of the benefits of this survey. We know it is a significant effort by the Conference of State Bank Supervisors and also our state banking supervisors, and of course, a significant effort by our community bankers to respond to this survey. But year after year, we gain new insights into the opportunities and challenges facing community banks. And the survey should be, a copy of the survey should be in your packet for those of you here in the room. And for those of you joining live stream, it should officially be posted on communitybanking.org. So I will turn it over to this year's survey team to share with us the results of this year's survey.
Thank you, Jim, and welcome everyone. We are excited to share the 2024 results of the 11th CSBS Annual Survey of Community Banks. I'm joined today by Tom Seams, Chief Economist at CSBS, and Kathleen Navin, Senior Business Economist at the St. Louis Fed. These two experts are going to once again help us disseminate this year's results. It's been an interesting year in banking. Last year when we presented, we were 6 months removed from the closures of Silicon Valley Bank and Signature Bank, and sticky inflation remained. And most economists were anticipating a recession. The survey results showed that bankers were reacting directly to what felt like a paradigm shift in banking, with a wait-and-see approach. Fast forward to today, we recently had our first interest rate cut since March 2020 on the back of what many of those same economists are calling a soft landing. Based on this year's survey, we can see that bankers are now focused on dealing with some of the regulatory and supervisory changes that have come about since those events in March 2023. This year's survey questions focus on current banking conditions, liquidity, regulatory risk, and technology. I encourage you all to pay close attention to these results. Early in my career, I worked for the professional football team in DC, and one of my favorite stories where my current work world and my past work world combine involves former Fed Chair Alan Greenspan, who often came to the games. Rumor has it he would seek out FedEx founder and chief executive Fred Smith at halftime to quiz him on the economy. Greenspan saw the shipping giant as a key indicator of the economic environment. And I think Greenspan would enjoy giving our survey a read. And maybe he does. Much like shipping companies, bankers receive critical intelligence and analyze the economy every day. So it's great to be with you all. I see so many familiar faces in the crowd, so many friends. And we ask that you hold your questions till the end to allow for us to get through the survey results in full. I'm going to get us started by sharing some key findings before I kick it over to Tom and Kathleen to go into the details. So what are some of these key takeaways this year? The top 3 highest ranking external risks were cost of funds, regulation, and net interest margins. Cost of funds and NIM were also at the top last year, but regulation, while always a high concern for our bank respondents, jumped into the top 3. We see bankers have a renewed focus on funding. One item that stood out was an increased reliance on broker deposits, something to consider in light of the recent FDIC proposal on that very topic. This year, we asked bankers about perceived stigmas associated with various funding sources, such as the Bank Term Funding Program and the discount window. We learned that bankers have their highest satisfaction on accessibility of FHL bank advances and the lowest levels of stigma for public funds and those FHL bank advances. For internal risks, the top 3 were cybersecurity, technology implementation and costs, and liquidity. On credit quality, bankers have a mixed outlook for the next 12 months. Expecting credit quality to worsen for personal loans, CRE, and C&I. And on CRE, the highest concern is for office and retail. The outlook for 1 to 4 family, residential, and agricultural loans are neutral. So I've got a quote to kick us off on our next section on cost of funds. And this is from one of our 5 questions for 5 banker respondents. You can find those at the back of the survey. This is from Michael Bush of Burling Bank. When interest rates rose sharply in a short period of time, the cost of retaining deposits changed very suddenly, while the loans weren't repricing as quickly. While things have stabilized more recently, there has certainly been a chilling effect on loan demand and stress on the consumer with higher debt servicing costs. So without further ado, I will pass it to Kathleen.
All right, thanks, Joey. So we're going to dive in a little bit more on those external risks. As Joey mentioned, the top 3 were cost of funds, regulation, and net interest margins. Going to focus first on cost of funds and net interest margins. So one of the really interesting parts of the survey is as the CSBS asks these questions longer and longer, we're starting to be able to see more trends. So yes. So just looking at the past 3 years and those results, what I found interesting when looking at the survey results, net interest margins, while it did slip to number 3 in this year's survey results, the share of community bankers that listed this as either an extremely important risk or a very important risk, which is the metric used to determine these rankings, it was essentially unchanged. So over the past 3 years, 88%, 89%, 88% respectively. So very much a focus on net interest margins. That hasn't changed. But when you look at some of these other topics, they've just essentially kind of eked past the net interest margin. So cost of funds, while only 48% of community bankers saw this as an extremely important or very important risk in 2022, and it came in at number 9 that year out of 11, there was a jump last year, which we talked about last year, to 87%, came in at number 2, and then this year essentially tied for first. So cost of funds very much top of mind, 89% of bankers seeing that as a top external risk. And this relates also to one of the measures on the list of internal risks, which we'll talk about a little bit later, but liquidity is still very much top of mind. So when you look back to the results in 2022, as the Federal Reserve was beginning those interest rate hikes, but really more, the survey took place in April through early July. So at the beginning of that tightening cycle, liquidity risks were actually last on that year's survey, with just 35% of community bankers listing it as extremely or very important. Flash forward to 2023, and that jumped to the second most important internal risk. This year, liquidity remained top of mind in that top 3 for internal risks at 78% of community bankers. But as we'll see later, there's some other internal risks that started to come into the picture. There are, as you'll look through your packets, you'll see there are a lot of additional questions that help kind of drill down into these topics. One that I find very interesting is asking about the effects of inflation on community bankers. So when we think about cost of deposits, we think about liquidity, naturally think about higher interest rate environments that were necessary to bring down inflation. So asking about inflation, I think, really gets to the core of this and why we've seen this increase interest and attention on these areas. So what we see here is that when looking at the effects on community bankers, inflation has had the biggest effect on cost of deposits. So very much in line with what we saw on the external risks front. Coming in second, personnel expenses. So really cost of deposits with almost 60% of community bankers noting this was extremely impacted by inflation. And another very related topic, core deposits and growing and retaining core deposits. Now, while this fell just outside of the top 3 for internal risks, it ranked 4th this year, still very much top of mind. And when asked, how important are each of the following potential challenges to attracting and retaining core deposits, you see the largest share of community bankers saying it was either extremely important or very important comes down to bank market competition. Economic uncertainty came in second, but more of a distant second. So still seeing that focus on competition around deposits, it was very much a part of this year's results as well. And when thinking about retaining and growing core deposits, when thinking about liquidity, when thinking about these topics, a kind of natural second thing to look at is other sources of funding. So there's a question in the survey, what are your institution's intentions regarding the following wholesale funding sources? And you see the categories here currently utilize and plan to utilize in the next 12 months, currently utilize but plan to exit in the next 12 months, and then do not utilize but plan to, do not utilize but do not plan to. So I want to focus on that first category of currently utilize and will continue to utilize. You see public funds and Federal Home Loan Bank advances, very much the top of that list. But what I found interesting in this year's results was broker deposits came in at third, with almost 50% of community bankers that were part of the survey noting that they currently use those and plan to use those going forward. And that was an increase of 10 percentage points relative to just last year's survey. So I found that to be an interesting result. And another thing that I thought was really interesting about this year's survey, these special questions help provide additional color on this. There were 2 special questions. The first related to accessibility. So we're going to go ahead and advance. There we go. So this question, in your experience, how satisfied are you with the accessibility of the following funding sources? And you see that Federal Home Loan Bank advances, public funds rank very highly. In fact, Federal Home Loan Bank advances very much the highest, with almost 90% saying they were at least somewhat satisfied. So extremely satisfied or somewhat satisfied. Now, also you see broker deposits coming in third again. So we saw that they were being used and plan to continue being used. And here you see, generally thought of as being quite accessible. An additional question that was asked in this year's CSBS survey was about stigma. And so when we look at what's going on there, the question, what level of stigma, if any, do you feel is associated with the following funding sources? So you see, maybe go down to the lowest levels of stigma first. Public funds, FHLB advances, those ranked, as having mostly either low or no stigma associated. So consistent with what we saw before. What's interesting is that brokered deposits, while being the third most used and also the third viewed as the most accessible, still had higher levels of stigma associated with it, with over 50% of respondents associating at least moderate levels of stigma. Now, what you see in these results is the highest levels of stigma associated with emergency facilities, with 40% of respondents associating these with either high or very high levels of stigma. And then roughly a quarter of respondents associated either high or very high levels of stigma with discount window advances. So these type of special questions really give more insight into what are the views on these wholesale funding sources. And for even more additional insight, I'm going to turn it over to Tom, who's going to walk through some additional economic data that kind of gives color to the survey results.
Thank you, Kathleen. So interest rate management has really been pretty complex and more difficult over these past 3 years. The Fed raised the Fed funds rate about 525 basis points from March of 2023 to July, or 2022 to July of 2023, and then did not lower them until just this last month. Now, of course, this was precipitated by the rising inflationary pressures that followed the pandemic and the lockdowns in 2020. And hope are that the inflation rates are going to continue to fall towards the Fed's 2% goal. Their goal is, of course, PCE inflation. This shows some other measures, but they're all trending down, which is a good sign. But for banks, interest rate increases raised both the yield on the earning assets and also the cost of funding those earning assets. So we have both the blue line and the yellow line going up there. And overall, banks have actually done a pretty good job of maintaining some pretty decent net interest margins, over 3%. These are overall all banks, but they have declined over the past year from 3.28% to 3.16%. The biggest hit has been in managing banks' securities portfolios since rates began their climb. And as shown here, the unrealized losses on investment securities remains far greater than in previous years. Now we go back to Joey.
All right, so I'm going to kick off our regulation section with a quote from Lori Maley from Bank of Bird in Hand. And I want to provide some context to this. Bank of Bird in Hand opened in 2013 as a de novo, and I think that's important to consider Lori's perspective in this quote. It is almost impossible to start a new bank today with all the regulatory burden and costs. So the barriers for entrance are too high, and it's creating a deficit of new banks. I think we will not see any new banks coming out of the gate to replace the banks being merged out of existence. This is going to lead to the creation of more unbanked and underbanked communities in the United States. Kathleen, back to you.
So to close out the external risk section, going back to regulation, essentially tied for first in this year's listing of external risks. And when we compare this to the last few years, what I found interesting is that steady increase in the share of community bankers that listed this as either an extremely important or very important external risk. So we see that increase from 77% in 2022 to 81% in 2023, and then 89% in 2024, so this year's survey. And as a result, regulation went from tied for fourth in 2022 to tied for first in 2024. So interesting to see that steady increase. And for some additional context, I'll turn it over to Tom.
Okay, so about 10 years ago when I was at the Dallas Fed, I used to go out and visit some banks, and this display was in the lobby of a bank out in West Texas. And what it shows is the banking acts that go back to 1913 with the Federal Reserve Act. It was 31 pages when he printed it out. And he printed out several other acts in between there, but on the far right was the Dodd-Frank Act of 2010, which had 849 pages. So community bankers' concerns about regulatory burden really do not seem to be overblown. This chart shows the number of major banking acts passed by Congress in the blue bars, and then the number of pages in those legislative acts over the past 12 decades. While it appears that regulatory burden has declined over the past 2 decades, the rulemaking by government agencies has picked up. And Chair Clark mentioned some of the statistics there. Dodd-Frank, of course, created the CFPB and many other reforms, and some of those are really still being written. I'm told that Section 1071, for example, has 3 legislative pages, but is 888 pages in describing the rules that banks need to follow. Moreover, the number of pages in the bank call reports started out about 60 years ago as a 2-page document, and it's now around 90 pages. Interestingly, the number of pages in bank call reports appear to have increased after major recessionary periods, as indicated by the gray shaded areas on the chart. Also, the regulatory burden indicator in our quarterly CSBS Community Bank Sentiment Index, known as the CBSI, which we established in 2019, shows that community bankers have always been concerned about regulatory burden, but they became even more concerned starting in 2021, and the level of that regulatory burden has been in the 20s since that time. I'll give you a preview of what it's going to be next month, or next week when we release the press release on it. That number 20, it's going to be 20 again, even though the overall index is going to rise by a little bit.
One more.
I think I pushed the wrong button. Oh yeah, okay, and this also comes from our CBSI survey. We asked the question, basically, what keeps you up at night for the bankers? And government regulation has been top of mind since we started asking these questions in 2020. It is currently top of the list and will remain top of the list when we release our third quarter results next week.
So I'm going to kick us off with another banker quote for cybersecurity, and you just heard Tom mention the CBSI. This is an anonymous quote from the CBSI open response section. Cybersecurity is the biggest factor for the future of banking. 2 or 3 banks going out of business from a ransomware event will cause a flight to too big to fail, which will permanently damage the community banking sector. So Kathleen, back to you.
Thank you. So turning to the rankings on internal risks, you see here the full list of rankings. Cybersecurity, again at the top. This is not new. Over the last 3 years, cybersecurity has consistently been that top spot in terms of what is viewed as the biggest internal risk that banks are facing. You see here the shares have varied a little bit, 96%. In 2022, dropped a little bit to 93%, still very high, but back up to 96% of those being surveyed saw this as an extremely or very important internal risk. So for some additional context, I'll pass it over to Tom.
So cybersecurity is a concern not only of banks, but of governments, hospitals, businesses, really you name it. Ransomware threats continue to plague financial institutions. In 2023, ransoms were paid by U.S. businesses topped $1.1 billion. Also, supply chain disruptions from software glitches are a real and ongoing concern, highlighted by the recent CrowdStrike mistake that caused financial damages of roughly $10 billion. And then finally, geopolitical instabilities and uncertainties has motivated a lot of domestic and international hacktivists to attack.
All right, so on to tech costs and implementation. I've got another banker quote. This is from David Ellis from Rivera Bank. We understand these competitors are here and they are here to stay. We need to figure out how we provide value to our customers. Capitalism is competitive, right? You have to earn your right to exist every day. What we have found is that from a technology standpoint, we often have the technology offerings that are as good as many of these non-bank competitors. Kathleen?
Thank you. So going back to the overall listing for internal risks, earlier you may remember that I mentioned in last year's survey, liquidity was the second spot. It was displaced this year, moved to third, and it was replaced by technology implementation and costs. And when you look at how that has progressed in recent years, again, a steady increase in bankers that are saying this is either extremely or very important. So from 76% of those surveyed in 2022 to 77% to nearly 80%, so with rounding about 80%, and that moved it into the second spot. And an additional question from the survey that I thought provided some interesting context around this: what is the most significant impediment to adopting new technologies? And you see that 46%, my eyes are not good enough to read that far, so 86% saw cost or ability to implement as an impediment to adopting new technologies. So, that was very high on the list of risks. Second, cybersecurity risks. So those top two internal risks also seeing as kind of the dominant share on why that there's impediments to adopting these technologies. And with that, I will hand it over to Tom.
So the cost of technology implementation and the speed of implementation is increasing at faster and faster rates. And this chart is just intended to show you the pace of adoption of technology and how it has increased over time. The slopes of the lines, we used to adopt technology fairly slowly, and now we all get a cell phone right away, or whatever the new gadget is, and put it to use. So with AI on the horizon, there's a lot of concern in this space.
All right, so one last banker quote, and this one is on credit quality. Oh, this was another anonymous banker from the CBSI. Quote, we are seeing some stress with consumers. Consumer loan delinquency is picking up a bit and NSF activity is increasing. Kathleen?
Thank you. So on the special questions, and this year there were 2 special questions related to credit quality. And the first just asking about expected credit quality across a variety of loan types, including loans to individuals, commercial real estate, commercial and industrial loans, 1 to 4 family residential, and then agriculture. And what we see is that nearly 65% of respondents expected credit quality of loans to individuals to be either somewhat worse or much worse over the next 12 months. So kind of the most caution toward those loans in terms of credit quality. Concern was also expressed around credit quality for commercial real estate. So that's second there on the list. About 62% of community bankers surveyed expected at least somewhat worse credit conditions there on CRE. Now, a little more than half of banks anticipated that commercial and industrial lending was going to be at least somewhat worse. On the more neutral side, we have about half of bankers saw really no difference in lending on 1 to 4 residential in terms of credit quality. So really most of the focus being on loans to individuals, commercial real estate, and then to a lesser extent, those C&I loans. Now, interestingly, views on agricultural loans, credit quality about mixed. So pretty much evenly split between no difference or somewhat worse for those community bankers that are active in those in that type of lending. Now, given the emphasis on commercial real estate, there was an additional question in the CSBS survey that asked, over the next 12 months, where do you expect credit quality to be across the following CRE property types? So asking for those 5 major types: office, retail, industrial, warehouse, lodging, and multifamily. And I think probably no surprise at the top of this list being office. So about 20% of respondents anticipated credit quality on office loans to be much worse. This was by far the largest share. And if you expand that to include those that said they expected it to be somewhat worse, an additional 51 percentage points. So over 70% seeing that as either somewhat or much worse. Next, another interesting piece of information was the second spot. So on retail, bankers also expressed concern here, and you see that about 60% anticipated credit conditions on retail loans to be somewhat worse. Much more neutral views on the other 3 types. You see that middle option of really no difference in credit quality, really the dominant share for industrial, warehouse, lodging, and multifamily. And really, multifamily at the bottom there, really having the least amount saying they expected it to be at least somewhat worse. So an interesting result from the survey. And with that, I will hand it over to Tom.
Well, concerns over CRE in the office space are really the result of 2 factors. First, as we see here, with more remote workers, office vacancy rates have climbed steadily since the end of the pandemic and the lockdowns. At the same time, we see rising interest rates have made office properties more expensive to tenants. So delinquencies here in the CMBS markets have climbed, most notably here in the office, which is in green, and the multifamily, which is in yellow. This chart isolates that the overall office against the overall trends, and we can see here that the office numbers were under 2% in 2022, and they're around 8% delinquencies today. The warning is watch out for whoever holds some of these assets. And because interest rates are now about 5 percentage points higher than they were a few years ago, we're seeing resets at much higher rates. And there's about $600 billion that will reset each of the next several years when these deals were made at lower rates at that time. And then finally, just a note here on consumer loan delinquencies. The chart shows that there are some increases recently in credit cards and personal and the overall trend. It's still trending down for real estate, but these are not yet at problematic levels. You can see where they are compared to where they were pre-pandemic and going backwards in time. So something to keep an eye on. They're rising, but the question is, of course, how high will they go? And with that, back to Joey.
All right, Tom and Kathleen, we were unsuccessful running out the clock, so we do have time for Q&A. So raise your hands if you've got a question.
Sure. Troy Kravitz at the FDIC. I have a question. It comes up through Charlie's talk and in the results of the survey that there's a lot of concern over regulation, and I think very justifiable concern over regulation amongst community banks. Perhaps from a regulatory perspective, it seems like there is a desire for more capital regulation. Do you have a sense of whether the community banks would view a trade-off of greater capital requirements in exchange for relaxation of some of those regulations would be something they would be amenable to. Granted, that's a false dichotomy. I acknowledge that from the start. But that seems like a way potentially out of the continuing regulatory overload.
Yeah, I think that makes sense to me. You know, some kind of tailoring and maybe different charters even, right? That's established in that way. I would just like to point out, really, on the whole, regulatory burden front. We have a lot of researchers out here in the audience, and I think this is something that we really need to get a quantitative handle on. If we can quantify the costs of regulation for different sized institutions and maybe in different areas of the country, this would be a great benefit to having better understanding so that we can put the right policies and laws in place.
I think we have time for one more if we're fast. Anyone? Commissioner Hall?
I'm really loud, so. I'm really loud. It'll be fine. Just in response to the question, I think that a lot of the regulatory burden that banks identify right now has very little to do with balance sheets and so much more to do with compliance, BSA, IT. IT is it's the worst. And it's kind of like my examiners. They want to look at balance sheets. Bankers want to make loans. They don't want to become experts in cybersecurity and third-party multiple levels of third-party audit for providers and vendors, and they're being forced into that. And so for my community banks in Montana, I think that the regulatory burden, the pressure they're feeling comes from a requirement, not so much in regard to capital or loans or even liquidity right now. The regulatory burden side of it comes from all of the other stuff.
Excellent point. I think that if we can, again, get researchers to get in on that and figure that out for us, it'll help a lot.
All right, with that, please join me in thanking Joey, Tom, and Kathleen. And again, thank you to CSBS, to the state banking commissioners, and to the community banks who responded to the 2024 annual survey. I know the 2025 annual survey will begin in April of 2025, so look forward to that.